Hi, and welcome back to the Business Career College video series. In this video, we're going to look at the taxation of capital gains. Now, hopefully you've already watched the video covering the basics of the taxation of investment income. And if you have, you'll recall that capital gains are subject to a 50% inclusion rate at the time of disposition. So you can have capital gains to the extent that you want without paying any taxes. To the extent that it's possible, you can have those gains, but until you actually dispose of that property, you generally won't have any taxes to pay. So this provides me the benefit that if I bought something in, let's say, the year 2000, and I sell it in the year 2015, all the way along while these gains are happening, I have no tax to pay. I won't have any tax related to the growth in the value of this asset until we dispose of that property here in 2015. Now, any regular income like interest or dividends that this thing pays me along the way, that's all taxable. But the actual growth in the value of that asset doesn't get taxed until I dispose of it. So you may recall that the formula for the taxation of a capital gain is based on our proceeds of disposition minus our adjusted cost base, or ACB. So proceeds minus ACB gives me my capital gain, or in the case that this is negative, my capital loss. So let's work through a couple quick examples here. It's real easy. If you have somebody who sells a piece of property for $15,000 where they had paid $10,000 for it, they would have a $5,000, what we would refer to as capital gain, and then we would apply our 50% inclusion rate, and we have a $2,500 taxable capital gain. And then we would apply your tax rate to that $2,500. It just gets added to whatever other income you have for the year, and that would describe for us the total amount of tax that's owing. The effect being that that's taxed at half the rate of normal income. Now we can flip that around, and we can see that what happens if you sold something for $10,000 when you had paid $15,000 for it. Well, then you would have a $5,000 capital loss. Once again, we apply the 50% inclusion rate to that capital loss, and we have a $2,500, what we properly refer to as allowable capital loss. And what that does, that allowable capital loss, for the most part, can only be used for a select number of things. I can offset a capital gain. That's the primary use of it. So I have to have a capital gain in order to use my capital loss. And properly, we would apply a $2,500 allowable capital gain. That would be exactly enough to wipe out the tax owing. A $2,500 allowable capital loss would be exactly enough to wipe out the tax owing on a $2,500 taxable capital gain. There'd be a perfect offset there. But what if I don't have this capital gain in the current year? Well, with my capital loss, I can actually carry it back. So the gain has to be declared in the year it happens. But with the loss, I can carry it back 3 years. Or I can carry it forward indefinitely. So I can carry it forward as long as I need, until I actually do end up with a capital gain against which I can use it. And if you should have to carry it forward all the way to death, or if you end up dying and you don't have any capital gains, well, then you have a second opportunity to use it here. So in the year of death, and this applies both to capital losses that arise in that year and capital losses that you've carried forward, you can use your capital losses against any income. Now, that only applies at your inclusion rate. So, for example, if you have a $2,500 allowable capital loss, you would be able to offset $2,500 of any other sort of income. So those are our gains and losses, real briefly. Now, there are a number of circumstances that would constitute dispositions of property. That is, circumstances when you would have a capital gain or capital loss. So the first thing we look at is the types of property to which this applies. What we're looking at here, we might look at real estate or real property. That will be land and buildings. We might have investments, unless they're held in a registered plan. You might have some special treatment applies here, but this applies to what we call listed personal property, which is things that you buy that sort of skirt the line between collectibles and things that would actually have a growth in value, things like art, for example, jewelry and antiques. And then you might have personal use property. Personal use property is your car, your clothes, your house. And on this stuff, you cannot have any losses. No capital losses are possible here. So this is basically the kind of property to which capital gains treatment applies. It does apply as well to depreciable property, which would include things like machinery that you buy in a business. You'll note then there are a number of pieces of property or types of property that this treatment does not apply to. It does not apply to life insurance, for example, is not considered capital property. It does not apply to anything that sits in a registered plan. Your RRSPs and pensions are exempt from this capital gains treatment. And there are a few other odds and ends, but for our purposes now, that's sufficient. So the possible dispositions of property that I can have then would include, obviously, a sale of property. If I make a gift or donation of a piece of property. The big one for insurance purposes is death. When you die, that constitutes a disposition of all of your property. When the property is going to go through what we call an involuntary disposition, if it's destroyed or stolen. If you have some sort of trade or barter arrangement with this property, you give it to somebody else in exchange for a piece of property. This would apply when you leave Canada. If you become a non-resident of Canada and sever residential ties with this country, that's a disposition of your property. A change of use. When you change a piece of property from personal use property, let's say, up to, let's say, income producing property, that constitutes a change of use, and that's a disposition of that property. So we can see a number of different circumstances that would arise here that would cause us to trigger the gains that we see over on the left side. So we have to watch which of these circumstances we're going through, and is it going to trigger one of these gains. I hope that that helps. Oh, I'll mention one more here, sorry. If you have a change of ownership, such as transferring a piece of property from individual ownership into joint ownership, that properly from a tax perspective constitutes a disposition. So I hope that's helpful with respect to capital gains and capital losses. If you're studying for one of the life insurance or mutual funds exams, then you'll find probably the stuff on the left is sufficient, and the stuff right at the bottom here. When you get into the financial planning exams, you certainly have to know all of the various dispositions of property and so forth. And obviously for anybody going through one of the basic exams, life insurance or mutual funds, the disposition of property at death also becomes quite important. I hope that helps. I hope you enjoy your continued studies. Thank you very kindly.